All right. Welcome to the Well Actually podcast. I am your host, Told You. Happy 2022. Happy New Year to all of you. And I am joined by a special guest who is here to drop some knowledge. But remember, at the beginning of this, I'm going to say none of this is investment advice. This is just for educational purposes. What we're trying to do here is help you learn where to aim your research. So again, do your due diligence. But again, this is a conversation that we all need to have. And with that, I would like to welcome the investing party herself, Miss Sheeta. Welcome to the show.
Hello. Hi, everyone.
All right. So we have a lot to get to. A lot.
We do. I'm excited.
And, yeah, I was doing my research and I was like, you know what, let me just go through and pick like 3 or 4 topics so that we could. My list has about 20 things, so and we have about an hour to get through it. So we're just gonna start off. First of all, this episode of the Well Actually podcast is brought to you by NijaFoodDepot.com. Remember to use promo code podcast to get 10% off your next purchase. That is NijaFoodDepot.com.
Oh, wow. Do they ship everywhere?
Yeah, all over the country. Well, except
wow.
Alaska and Hawaii.
Yeah, I don't think there are any Nigerians there.
Yeah, you'll be surprised. There are Nigerians.
I know.
Nigerians pop up. Nigerians pop up everywhere. But yeah. All right. So to start off, I want to say, like, first of all, like, the reason why I invited you on is because I am someone who consumes your content. I have watched some of your Instagram lives. I've like scoured your page for tips and tricks or whatever. And like, you know what? Why not just have her on and let her share this knowledge herself? So go ahead and introduce yourself. I don't want to say your bona fides, but like, what do you do in this realm?
Absolutely. Thank you so much for having me on the Well Actually podcast. Told you, it's definitely much appreciated. Hello, everyone. My name is Sheeta. I am the chief chief motivational person to encourage you to put your money to work at Investing Paddy. So I started Investing Paddy August 2020. And what Investing Paddy is it's a community of people who are either women, minorities, or immigrants. And we talk about money, how to not only earn money, but how to maintain our money and how to put our money to work by investing our money. So I had started the community because I found a gap within the 3 groups I mentioned, which is women, minorities, and immigrants, all of which I identify with. I found a gap in a sense that a lot of those people, a lot of women, a lot of immigrants, a lot of minorities, money is one of the things that we struggle with. When maintaining our money, holding on to our money, multiplying our money is one of the things we struggle with. A lot of us feel like in order for us to earn money, we have to physically work to make the money, which is true as part of the equation, but it's not the full equation. The equation is not just earn, spend, earn, spend, earn, spend, and it's like a repetitive cycle. The equation should be earn. Yes, you should spend some of your money, but you should also have a system to save and maintain a portion of your money, but it shouldn't just end at saving. You should also like invest the money, and which helps you multiply the money. And along with those 3 things I mentioned, I also encourage people to invest in the stock market because it's one of the few investment tools that allows you to get started with investing with very, very little amount of money. So yeah,
Okay.
that's me.
Okay. All right. So we're gonna touch on the stock market in particular, but I noticed on your page that you had something where it was like 5 ways you can start investing in your future. Obviously, one of them is stock market, but there are some lesser known ones there, and I was like, huh. Like I was going through, like, oh, because I consider myself like at least a little knowledgeable in some things. Like, oh, okay, this is something I hadn't even considered. So would you mind going through what those 5 ways that you could start investing in your future?
I'm not too sure what post should prefer.
Okay, so it's you know what, I'm gonna pull up your page because I
I'm
like
like,
I
because
said, I
there
do
are
my
like probably
reserch.
multiple ways, but I just like summarized it to the
Yeah,
five.
yeah. So it's okay. So you know what? I'm going to read
So,
your page to you in
oh,
particular.
okay, okay, I got it, I got it.
You
So I got it. So when it comes to like the stock market, a lot of us, a lot of people got like last year, 2020 actually, because 2020, 2021, mainly 2020, a whole lot of people were talking about the stock market. It was all over the news. People were talking about companies that were like significantly going up, and like also everyone was talking about Bitcoin. So there was a lot of awareness to the stock market, and people started asking questions. And you know, with but what a lot of people don't know is that you're probably already an investor in the stock market. And I think that's what the post was alluding to, in a
okay?
sense that there are 5 ways that you can start investing in the stock market. Um, so the first is the 401k, which
Okay.
is, your employer's the retirement account that's given to you when at your employer, at your company. So your employer provides a 401k for you. And what a 401k pretty much is your retirement fund. You can put money in your 401k, which I highly encourage everyone to, regardless of what your age is. And some employers will provide a match for you and say, hey, if you put in X amount of money, we would either give you 50% of that money, or we will double the money for you.
Double.
Yeah, there's a match. Do you have a match? Do you know if
Oh,
you have?
I'm self-employed at the
Okay, you're
moment. Yeah.
self-employed. You
So
you can actually, as a self-employed person too, you
Niger
also
Food
can
Depot.
give you. Okay,
That's me.
Nigeria Food Depot.
Yeah.
Okay, I didn't know that was you.
You know,
That's
see, I was
cool.
that I was going to get to the advice portion for business owners at the
That's
end,
a
but
nice
see,
plug. But no, you can also have a 401k too. But if you work for like, if you're not self-employed and you work for a corporation, if you know, make sure you check into your 401k. Most employers give you a match, which is free money, so you can instantly double your money based on, what the match is. Along with that, a lot of people are not aware that your 401k is actually invested in the stock market. I was actually one of those people. I didn't know my 401k was being invested in the stock market. I just knew they were taking money on my paycheck. I didn't know where it was going until I started to investigate and do more research. And that's where I learned that, hey, you're already invested in the stock market, you're already participating. The next one is the HSA, which is the Health Savings Account. This is associated with a high deductible health insurance. So it's associated with your health insurance.
okay,
Um, when you get health insurance, you can either get one that doesn't have a high deductible, meaning that the high deductible means that you get a very low premium. So the money you're paying out of pocket every paycheck for your health insurance is significantly low. But when you do have to, like, let's say you go to the doctors and you have a doctor's visit, your deductible, the amount that you have to pay before the insurance starts covering you is higher, because the premium you're paying per paycheck is significantly lower. That's usually like a lot of people who don't go to the doctors frequently, who only go to the doctors for like annual checkups. If you're relatively healthy, maybe that might be a good health insurance for you. But if you have a high deductible health insurance, one thing the government does to help pad and help you manage that high deductible is they give you an opportunity to put money away into a health savings account, which is HSA. Um, One of the things that a lot of people do not know about the HSA, which I was one of them,
I am one of
hence
them.
the reason.
I yes, I
You're
am one of
still
them as
one of
well.
them.
Yeah,
You're one of
yes,
them. Okay,
yes.
we're gonna change that, and
Okay,
that's okay. That's fine. One thing a lot of people don't know is that your HSA can be invested. The money in your HSA can be invested. You can, usually when you have a HSA, this is a different provider from your health insurance provider, but they would give you that information. You can log into the HSA provider, and it would ask you, do you want to invest the money? And most times, the opportunities they give you is like mutual funds, and you can choose a mutual fund and invest the money. The money, if you invest the money grows, and there are also benefits to that too. So there's so much. I feel like HSA can be a whole episode on its own.
Yes.
But
Oh wow.
there
Okay.
there are benefits to it because it's pre-tax. So the money that you're putting in your HSA, you're not paying taxes on it. You're getting a tax deductible on it. The money that is growing in your HSA. So if you invest the money and the money grows, let's say you invest the money and like 10 years from now, that money doubles. So it went from like $1,000 to like $2,000. You don't pay anything on the growth. You don't pay any taxes on the growth because there's no taxes on the growth. The third thing is that if you take that money out to spend on medical bills, you don't have to pay taxes on it. So there are lots of benefits to HSA. This is another way to invest.
Okay.
The third investment tool that I mentioned is IRAs, which is individual retirement account.
Oh, now we're
So
talking. Okay.
yeah, so you've gone through your 401k, you've gone through your HSA if you have a high deductible health insurance plan. Now you're just like, okay, IRAs, which is another retirement account that the US government offers to every single one of us. So you can either do traditional or the Roth. Traditional is you get a tax deduction. So if tax deduction is something that's important to you, you can go with traditional, but there's an income limit to it. If you're a high income person, you might not be eligible for the deductible. Just Google 2022 traditional IRA income limit. I'm not too sure what it is right now. But if the other aspect is the Roth IRA, which is you don't pay taxes. Actually, you pay tax. It's the money you put in your IRA is not deductible. But if that money ever was to grow to like $1 million, and when you're like 59 and a half, you want to take out the money, you don't have to ever pay taxes on the money ever. So
Oh.
yeah.
Oh, I picked correctly then. Okay. Okay.
And then the last one is the taxable brokerage, which is the one that most people think about when we think about the stock market. So it's like that's not the only account. Actually, there are other accounts that should be considered first before you actually get to your taxable brokerage. But that's the one most people think about, which is like the likes of like just opening up a regular.
So like Robinhood would count under this.
Yeah, a
Oh.
Robinhood is strictly just a regular taxable brokerage, which is you can put money in it anytime. There's no maximum amount of money you can put in. There is you can buy and sell and take your money. In all of them, you can buy and sell at any time, but you can't just take your money at any time because the other ones are associated with like retirement or like
Right.
medical, whereas with taxable brokerage account is nothing associated with it. So you can always take the money, your profit out at any given time, and there are no restriction. But the only thing with that is that there is no tax benefit to it. So you will have to pay taxes on the profit you make when you sell, if you decide to sell your investments.
When you say you have to pay taxes, do you really have to, or is it just advised that you do?
You do. You should put it in as you're supposed to put it in as income. That's like the government says you should put it in as income, and your broker is going to send you a tax document at the end of like this year. Like the year just started, so they should start sending you a tax document. And I think it's like a 1099, and you're expected when you go file taxes, take that and give it to your tax person as part of the income you made. And if you make losses too, you can also claim losses too.
Oh, okay. Okay.
Yeah.
All right. That makes me feel a little bit better.
IRS also gets a copy of it. So if they ever audit you and you don't claim it.
Wait. So they're asking me for a copy of the homework that they already have, basically.
Yeah.
Wow. Okay. That's
all your income.
Okay. Okay. Oh, good thing I asked you that before filing. Thank you. Don't want to end up like Wesley Snipes. Well, okay. So yeah, so those were wow. So that was the 401k, the HSA, Roth, and traditional IRA,
Yeah.
the regular taxable
Brokerage account.
brokerage.
Uh-huh.
Okay. All right. All right.
That.
All right. I mean, I listen. I listen. So yeah. Without giving too much away, I'm basically at the age now where my friends are having kids on purpose,
Okay.
and
Good.
I'm trying to figure out, like, give them a reason to listen. So I know a little advice for them. So it's like for them who are trying to, we have these buzzwords of generational wealth and how going forward we'd like to, set up our kids for, a better life. We want them to be the trust fund kids that there's so much animosity towards them. Like, hey, I mean, if you got it, sure, but the whole point up till now is that there were these barriers to entry, whether it was financial or knowledge based or just like skin color or what. It's just, but like the fact that a lot of the information is now democratized. So to anyone who is in that situation where they have kids, they're expecting kids, they want kids, what are some of the avenues that they have in terms of like setting something up for their children?
Yeah, I love that you said that information is now democratized. So, like, information honestly is wealth. And right now, we're in a time right now where everyone is sharing, where it's not so hard to get the information. It really just boils down to, are you ready to receive it and are you ready to apply the information? Investing for kids is something that I'm really passionate about because as a parent, you can make your child a millionaire. Like, you,
Oh,
you really
okay.
can if you get started really early for them and with very, very, very small amount of money. And the reason being is that, like, when you talk about investing, um there are three things that impacts investing. The first, obviously, is the amount of money you're putting in, which is your capital.
Mhm.
The second thing is, okay, how much is it growing over time? And the third thing is time. Time. So most times people are impatient. People are like, oh, I want to get rich quick. I want to like we're living in a microwave generation where everyone wants to do everything so quick. Like I want to like have my quick, quick, quick. But that's with that mentality, you're taking on a lot of risk because you're trying to achieve a higher return in a short period of time. Whereas if you start like investing for kids, right? You don't need a high return. You probably like a 10% return over like maybe like 30, 40 years of your child's life if you start investing for them at a very young age with a smaller amount of money is going to work out to a huge sum of money when they get older. And that's because you started early and the money started multiplying early. And as it's multiplying, it's not just the money that you invested that's growing, it's now the money that's multiplying and multiplying that's also growing. And that's what they call compound interest. So, like, investing for kids is something that if you have, not even if you have the luxury, because you can get started with as little as like $5, $10, committing to that every month for your child and opening up an investment account. It doesn't have to, like, you like literally in the stock market. And there are different types of investment accounts for children. You have like the 529, which is the educational investment account.
Okay.
And this is state based, so each state has their own 521 plan. And what that does is that based on your state, it could be the money you contribute in it up to a certain amount could be tax deductible. Like you could get a state tax deductible, not a federal tax deduction, a state tax deduction.
Okay.
Along with that, the money that grow, like when the money grows, right, and you decide like your child is ready to go to college, your child, like when you take the money out for college expenses, you don't have to pay taxes on anything. as long as it's for college expenses. If it's not, if you decide to take money out for anything other than college expenses, you will have to pay a 10% penalty and pay taxes.
So what counts as college expenses? Because like
I love how you're trying to find all of these,
I mean,
this
because that's
middle line, gray
because that's
line.
what they are doing. They they're loopholes because they're there. It's like all I'm trying to find out is the apartment or housing or transportation to college. Do those count as college expenses? It's like I'm not trying to put you on the spot. I'm just saying like
Yeah, I'm
that's
like,
for anyone who is looking into that. Like
they should be,
just do
yeah,
your research. Find
absolutely.
out whether that off-campus housing
It could
counts
count as,
as.
I
I
think
mean,
it should count as college expenses because think
see,
about it, when you pay tuition they add room
room
and
and board.
board in your
See,
tuition, so it counts as college expenses.
yeah.
There you
You see,
have it.
I'm getting a comment saying yes, it does count. So yeah. So
Okay.
see, that's rent right there. It's just and tax free. Oh, see,
Mm-hmm.
I'm just saying like,
I'm telling you, we be hating on the people who got trust fund babies, but they play the
hey,
game. They
hey,
play
that's
the game.
exactly.
And it's
See,
all about us knowing the game.
that's the thing. They know the loopholes and rules. We don't even know there's a game going on.
Yeah.
That's what
We're,
separates us.
we're not even in the race. We're not in the race. We're not even getting ready to start the race.
No, we're just outside wondering why there's traffic,
We're not even
and
on the bleachers.
they're in the stadium,
Hmm.
partaking, and we're wondering why there's traffic outside. But yeah,
Absolutely.
so you
So,
said the 529. So
yeah.
there are other
And
avenues for your kids.
yeah, there is. And another beautiful thing about the 529 is you don't have to wait till you have kids to start investing in a 529. So, like, I don't have
Really,
children. Yeah, I don't have children,
and you
but
just go ahead and invest in the 529 straight up.
yeah, so I don't have children, but I started a 529 last year and it's in my name. When
Okay,
I do have kids, hopefully, God willing, by God's grace, one day, I will make my child the beneficiary. So, like, you can always
gotcha.
change the person who's the beneficiary of that account, who's the
Okay,
person that's going to spend the money at any given time. So, if it's something you want to get started even earlier than you have kids, so you have way more time, why not? So that's the 529. It's just for education. If you use it for anything other than education, you will be penalized and you will have to pay taxes. The other investment account for kids is you have the IRA, so the Roth IRA for kids. But with that one, there's a big caveat. Your child has to have, in order for anybody to have like Roth IRA, you need to have earned income, meaning you need to have a job that's paying you money. You have to have income. There is a
so my
caveat.
kid has to be on the payroll.
Your kid does, well, yes, your kid has to be on a payroll. It doesn't have to be like an official payroll. If you pay
Oh,
your
oh,
kid less than, like, I think it's like 12,000 or 12,500, please don't quote me one of those two numbers. And that's this year. All these numbers change year over year. Uh, you can get a deductible, and then your child also doesn't have to pay taxes on the money,
okay.
and you can always, that's earned income, and you can put like a portion of that money in your child's Roth IRA. But in order for anyone to have a Roth IRA, they need to have earned income. Earned income is, I mean, talk to your tax advisor to see if whatever you're claiming as earned income for your child is legal.
Okay. Oh,
But
okay. You added that last caveat. That kind of
yeah,
killed my next question. But you said it had to
yeah,
be legal. So I'm assuming your child has to be born for there to be like to claim that they're getting income. Okay. So
yeah,
no
your
ghost
child.
employees. No. Okay.
Yeah,
All right.
your
All right.
child
Cool.
has to be a no ghost employees. Your child
Okay.
needs
All
to
right.
be
That's too
born
bad.
in order for you to have a Roth IRA
Okay.
for your child, because it's actually going to be a custodial Roth IRA. So it's going
Okay.
to be in your child. You're going to need your social security number.
Oh.
Whereas with the 529, it's in my name, so I am the owner. I am the custodian. When I have a
Okay.
child, I can switch it over to my child's name. But the Roth IRA, um it needs to be in the child's name, but the adult will be the overseer of their account because the
Okay.
child's not legally of age as of now. but it's also a retirement account, so you can access it till 59 and a half. You can take there's a lot more about it. You can access the money for other reasons, for like, so for first time home buyers, if your child was going to buy a house, they can access up to 10,000 of that money. But obviously, like I said, numbers change.
Right.
For buying their first home, for down payment on their first home. And there are also other caveats where you can take out the money for other reasons, but that's another episode on its own.
Okay.
The
Okay.
other account is, so we talked about 529, we talked about custodial Roth IRA. The next one is the custodial brokerage account. And with that one, it's a regular brokerage account, but it's not in your name. It's in both of you guys' names. So the account is for the child, but you are the custodian of the account.
Okay.
And so you're investing for the child. There's no tax benefit for that one.
But it's just like a straight up. It's basically like having a Robin Hood for your kid.
Yes, but you can't have. Robinhood.
No, I
doesn't
don't know, but no, I'm just saying like in
Yeah.
terms of like the type of account, basically.
Yeah.
And is there any limitation on the stocks that you can purchase for your child in any of these situations?
No.
So they don't
limitation.
care if you're like investing in like Smith and Wesson or
That's your business.
an oil company or whatever. Or just
Well, 529, there are restrictions. So
Oh,
529
okay.
doesn't give you like the luxury of like choosing different types of stocks. They mainly give you like, what also depends on the state, but most of them mainly only give you like mutual funds. But like with the Roth and with the brokerage account, you have more flexibility.
Okay, gotcha. Okay.
Yeah. And then with the brokerage account though, like once you put money in that account, you cannot take the money out for your own benefit anymore. The money no longer belongs to you. Because it's a custodial account. That money is for the child. So if you ever take the money out, you need to make sure you have it documented that, and explain and have a reason why you took the money out, and show that money is for the child's benefit.
Okay.
So
Okay.
and then the last one is just, parent having a second. You can decide to have a second like account in your name, but mentally in your head, you're like, oh, this account is not mine. It's for my child, because you have more flexibility. And if your child ever decides to act up, you can be like, it's my money. It's in my name.
Okay. All right. So I know you're not here giving investment advice. It's just like information
for
educational
talking.
purpose. Exactly. But if you could, like, I'm not going to say a recommendation, but do you have any list of like custodian brokerages that you're aware of, that in case someone wanted to do their research, they'd have a list to start with?
Absolutely. So I think you can look into Fidelity. So I believe Fidelity has like the custodial Roth and custodial brokerage account offerings. And then TD Ameritrade is another one. And I think Charles Schwab's has it. I'm not too sure. But yeah, one of those three. Good place.
All right.
And then 529 is your states.
So 529 is state-based. All right. So there was, before we move on to something else, there was something that I saw when it came to this whole like portfolio for your kids, and the numbers kind of shook me. And I was like, when we're doing like the prep, I was like, I'm not going to say these numbers to you until like so I can get your real reaction. And it was in terms of, okay, $200 a month at approximately 10% interest over 40 years would get you to $1 million.
Yeah.
$200 a month, investing $200 a month. So I want to be clear with this. I want to lay out for it. To give it that $200 a month. Invest $200 a month, and market return of approximately, I think you said between 7 and 10% is what the stock market typically gives. 40 years.
That's like an annualized average.
Yeah, annualized average
over time.
Yeah. So $200, 7-10% per year for 40 years. Get you $1 million.
Yeah.
And what that works out to in terms of what you're putting in is only $96,000.
It's on the post right here.
I told you I did my research. And
you did.
And I saw that and I was like, wait a minute. So when they're talking about generational wealth and all that, like that in itself right there is a hack. Where it's just like, just throw the $200, like rather than putting the money in a savings account, whatever. Just throw the $200 a
Yeah.
month.
Never, ever put your money you're saving for or you're trying to build up for your child in a savings account, especially for a child.
In fact, I would even like, based on what I saw on your page, I would just say savings account. No, that's like, just no. I
No,
I
no. Let's not be
no,
extreme. Let's
I
not.
saw, I saw where those decimal points went. I'm like, no, those
So,
decimal points are scary. Okay,
so I have to say something. You should
okay.
still have money in your savings account for your emergency savings. Life does happen. Life happens,
I'd
and when
rather just
life
have that
happens,
money under my bed.
the stock market is not always going to go up. Real estate is not always going to go up. Business is not always going to go up. There will be times where it's rough. They're rough times. They're rough
Yeah,
times
March
in life.
2020 was rough.
Yes, March
Yeah.
March 2020 was rough. So just imagine if you had all your money in there and
I mean,
something happened and you
it'd be
needed
back right
access to
now.
your money.
I mean,
But the point of emergency fund is not later in the future. It's right now. If you need that money right now, do you have access to it? So all of your money should not be in a bank. Absolutely. But you should calculate, like people usually say 6 months of your living expenses, you should have that as liquid fund. So you should at least have 6 months of your liquid expenses as an emergency savings in your bank, and that
so when you say
just
in the
put
bank,
that.
can
Mhm.
I'm talking about literally, can I just have it under my bed?
You can
I
if you want to.
Okay, all right. So that's okay.
Why would
That's
you do that
I
though?
I just don't like the fact that it's like I'm giving the bank an interest-free loan.
But the thing is that you gotta find banks that give you high interest rate, that have high interest rate. So
Hmm,
these are banks that are called high yield and savings account.
hmm,
High yield savings account. These
okay.
banks usually provide a higher rate than the regular like brick and mortar banks like Bank of America, Wells Fargo. Those ones don't put your emergency fund in there because it's not growing. It's like 0.001. But like
Exactly.
all of these like high yield savings account, a lot of them are not brick and mortar. A lot of them are online banks.
Oh,
The ones
okay.
I love Marcus by Goldman Sachs, and I love
Okay.
One Finance. I think One Finance is a new bank, and I love them. I'm actually trying to. Please sponsor me if you're listening to this. Hello.
That's One Finance.
Yeah, One
Yeah, One
Finance,
Finance. If you're
and
listening, just
but they
yeah.
have like their interest rate right now is 1%. If you do paycheck, if you do paycheck, if you deposit your paycheck in their
Direct
bank.
deposit.
Yeah, direct deposit. Thank you. They would give you 3% for like they'll give you 3% for 10% of your direct deposit if you do like the auto savings feature. But the guarantee one shot is 1%,
But if
and that's
you do
high.
direct deposit, it jumps from 1% to 3%.
Yeah, for
Three
10%
for 10%.
for at most
So
ten
it's
percent of your
capped.
pay.
Okay.
Yeah, it's
Yeah.
capped.
That no, that is hot. Like, wow.
Yeah,
Okay.
that's why
That.
don't put it under your bed. Your
Oh,
bed. There
okay.
are
I
other
mean,
ways. There's
when
systems to this.
you present this option, it might be a little bit better than putting it under the bed. I admit that.
Absolutely.
I admit that. But I like everything else is like
Yeah.
0.01%. It's like you put in $10,000 and you get like $10 afterward. And like
Yeah.
that won't even cover the monthly fee that you pay them.
Absolutely. The Bank of America is the 0.01001% or 0.01%, whatever it is. It's nothing. It's
Okay.
nothing.
Yeah,
That was
and they get
actually
away
my
with it.
first struggle with money like a few years ago, probably like 20, I think it was like 2017, 16. I was just like, oh, what is going on? Like I was a lover of Bank of America, and I was just like, something's not adding up here. It's not adding up. And that's when I started searching for high yield savings account. But
Gotcha.
everyone
Because
should
so
have a high yield
yeah,
savings account.
but then so as Nigerians, Africans, Caribbeans, immigrants, the thing that's been drilled into us is you earn, you save, you earn, you save, you earn, you save. And it's like at some point the mindset regarding money has to change. And I want to get your thoughts on like how do we like as a people, as I don't know if it's a matter of the income that we're starting with, or is it just the access to the information, or how does that mindset go from just earn and save to earn, save and then invest, like chopping up the pie differently?
I think that mindset shift is one of the hardest things, honestly, in every areas, every area of our life. We're all struggling with some form of mindset shift, trying to see that abundance, that opportunity, try to believe and get ourselves to see the opportunities that's out there. How do we start to change people's view of, because why do people save, why do people buy, why especially Nigerians, why are Nigerians like earn save, earn save, earn save, earn save? Well, other immigrants, actually, it's not even just Nigerians. Why are immigrants like earn save, earn save, earn save? It's a lot. um there is a lot. I think one, it boils down to the trust aspect of things, where it's like, oh, at least if you put it in the bank, your money is safe. At
Uh,
least if you put it in the bank, you're not going to lose your money. Your money's not going to disappear. And yes, investing definitely does come with its risk. And yes, absolutely, investing in a stock market has its risk. But that's why, as an individual, you need to decide what your risk tolerance is. If your risk tolerance is very, very low, there are investing opportunities that you can put your money in where your money doesn't disappear. It's probably not going to grow like exponentially, but over time it will grow. So how do you start to shift that mindset is, one, getting people to see, showing people examples of what is possible. I think when people start to see the possibilities out there, and that's what literally my Investing Patty, the Instagram page Investing Patty is for, getting people to see that, hey, this is possible if you put this amount and you hold it for X amount of time. It's possible, right? Getting people to see that, hey, it's possible, and showing them numbers and showing them, hey, I'm not just spilling numbers. um Also showing them that I'm not just spilling numbers, but maybe let's look at your record. You don't even, like I said, most people don't even know they're active participants of the stock market. Let's look at your 401k. How's your
oh,
401k performing? Let's look at it over time. Oh, look at it. It's been performing well. Oh, okay. It starts to spark interest where it's like, oh, tell me more. Now I want to learn more. So I think people, most immigrants don't trust investment opportunities. The only one that we really trust is real estate. We feel like, real estate is safe, but
mm,
real estate is not. I mean, yes, it's safe to a certain extent, but at the same time, the area you bought a house in can also not be that much of a good area years from now, and your property value can go down.
oh,
So
I
there,
mean,
there
you
are other
just brought up real
avenues.
estate, and that's a topic that is very dense right now
Mhm.
for a lot of parts. But no, sorry, go on, go on.
Okay. No, it's fine. And I think the other one is just the abundance mindset. So like, as as immigrants, and I think that's why I cited earlier, because as immigrants, think about it. Why did a lot of us migrate to America? A lot of us are in this country because we're here seeking for a better opportunity. We left our comfort zone, we left our home because we didn't feel like home could give us the opportunity that we could the opportunities we want. America is one of those countries where, I mean, yes, America definitely has its, commas and faults,
Absolutely,
but it's also one of those countries that if you put in a good amount of work, you see some returns. You'll see some
okay.
returns, and there's that aspect of, oh my God, I've earned this much. I don't want to lose my money. Like, there's sometimes we operate from a mind, like like, I don't want to say a lack mindset, but like we just want to, like, oh my God, I finally got it, so now I just want to hold on to it. But you gotta think beyond that. Think about ways that, hey, if you take this amount of risk, it's probably not going to be a lot of risk, but it could help you grow your money over time. It could multiply your money over time, and you shouldn't just hold on to it, because honestly, by holding on to your money and just saving, 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 you are losing money because of inflation. Inflation.
That's
You're
a
actually
buzzword
losing
right there.
money. you're losing money. Because think about it. Last year, that's why I made another post on Instagram about gas prices. Y'all think about it. The amount of money you paid on for gas in 2020, because the year just started. So I'm confused in 2022 and
You're
2021 at
not the
this
only one.
rate.
Not the
So
only one.
the amount of money you paid for a gallon of gas in 2022, was it the same amount of money you paid for last year? Absolutely not.
Not even
Gas
close.
prices went up. I had did a post about it. Let me find it to see how much up they did, but like they went up significantly. Yeah, they went up significantly. Like I made a post. It was like the average for the average U.S. gas price, $20 would have gotten you 9.4 gallons in November 2020. Fast forward to November 2021, a year later, $20 would only get you 5.4 gallons, which is 4 gallons less. Why? Because of inflation. So if you're putting your money in your bank and the bank is only giving you 0.01%, and inflation is last year, inflation was 6%, but usually it's around like 3%. But inflation is 6%, and you're only getting 0.01%. A dollar that you saved yesterday is not the dollar today.
Right. So you're losing money basically.
Yeah, you don't physically see that you're losing
Yeah.
money. You
But your
still have
money's
the
losing
same amount.
value. Yeah.
Yeah, you still have the same amount in your bank account, but your money's losing value. That same dollar is not in order. Like when you're spending the money, that's when you see the effect, because the money, the price they're charging you for that same item is a different price. Is a higher price.
It's that's a lot to deal with right now. I'm sorry. That is a lot to consider. It's like you feel like you're doing the right thing. You're doing everything they said you should do. You're not spending everything. You're putting your, I don't know, 20%, 50%, however much you save, and it's like, yeah, that money's not worth as much as it was when you put it there, and it's like that's not fair.
What if it's not fair?
Yeah, no. Oh yeah, no, we hear you loud and clear on that one. Life is definitely not fair at this point. No, I mean, I don't think it's ever been, but especially when it comes to your money, life is not fair. All right, so I wanted to get one, like I said, I have a long list of things that I want to talk to you about, and so this one, it feels kind of like timely for people who are like, whether the pandemic has like rearranged your priorities or has like put you in a place where you might be in more debt than you typically are because you're like trying to play catch up, but you're also trying to like dig yourself out of a hole. Like you don't want to be limited by your debt, but like, how can I invest while I'm still in debt? Like, is that even still a possibility?
Absolutely. It's a possibility. And I'm glad you asked that question because, you know, yes, you have the pandemic and life happened to a lot of us in 2020, 2021. And yes, people might have racked up a good amount of credit card debt because a lot of people lost their job in 2020. A lot of people were laid off, unfortunately, in 2020. Um, and along with that, like when we talk about debt, like there's also this huge student loan like plague
Oh yeah.
where
Oh yeah.
a lot of people are in student loan debt, like, and it's like a good amount of money. So debt is like one of those things that it's kind of like it's part of the American culture. Like think about it, we go to college and student loans is one of those things that we're expected to do as part of our, or to accumulate as part of our college, as part of our college education. So that is pretty big in the United States. And your question was like, how do you invest while in debt?
While in debt, like, are
A lot.
like, because I've seen like some calculations where it's like it's only a certain kind of debt that you should be investing
Mhm.
while you're in it. Others, they advise you to pay down before investing.
Absolutely. So you need to like compare what your student loan interest rate is to like your investments. So like for example, if you're investing in like an S&P 500 or like a total stock market, something that might give you like something like a 10% annually, you like if you have a credit card debt that's like 21% interest rate, you probably should focus on paying that off because
Okay. All right. So
they,
highlight Capital One first. Okay.
yes, it's
Okay.
significantly high and they are robbing you. So you need to like try to get that out the way as soon as possible. But like if you have student loan debt and like the interest rate is significantly low, like like a 3 5%, it's student loan, you can still like still pay off your student loan, pay at least what they're requiring you to pay on the student loan, so you're not like now um you're not you're not owing them and all that, you're in the red. Pay at least what they're requiring you to pay. But you I would say also still prioritize investments. So if you have extra change on the side, put that money towards investing, because when you compare the growth on the money versus how much interest that your student loan might be accumulating over time by you not paying it off instantly, the growth on the money might be more. And it's actually like it's like you working towards decreasing your loan and also increasing your asset. So at the end of the day, you're increasing your net worth because you're working towards reducing what your liabilities are, which is debt, and you're
Gotcha.
increasing your assets. So like you're by doing both at the same time and conquering both at the same time, you're working towards increasing your net worth. But if your interest rate is significantly high, like credit card interest rate, just focus on the credit card.
Okay. All right. That sounds fair.
Yeah.
A little debilitating, but fair. Fair
Why is it
nonetheless.
debilitating? What
I
happened?
mean, some people might want to holler at Robinhood before they holler at Capital One. But I mean, I mean, like I said, it's if it were easy, everybody would do it. So it's like sometimes uh, there are tough decisions that have to be made, and
Absolutely.
yeah. So I mean, but again, this isn't investment advice, not financial advice. Do your own
Yeah.
research. But
Yeah.
if
And
you hear
everyone's
something that sounds good to you,
yeah.
you dig into it a little further.
And it's different, it's different for everyone. Everyone's case is different. And another thing is that if you feel like you want to do both, you want to holler at Capital One, you also want to holler at Robinhood, you can pick up a side hustle. So pick up a
Oh,
side hustle that can sponsor the Robinhood. It's not easy, like you said, it's gonna be hard, but anything in life that you want, it's a journey. It's a
right,
journey
right.
to get it. And it requires work.
Yeah, no, you're 100% right. And yeah, so let me see what else, what other things, because I know, like I said, it's a long list, and I'm just trying to pick the ones that we can get to in this limited amount of time that we have. And there was something that the name of it seemed kind of funny, but the concept is real, and
Mm-hmm.
you called it lifestyle creep,
Mm-hmm.
where it's like, well, I'll let you define it for the people, and maybe like illuminate us with like some examples.
Absolutely. So lifestyle creep it really is what it is. It's like your lifestyle is creeping up. So like, you know, every now and then we get raises. Every now
Hmm.
and then we get bonuses. And it's nice, it makes you feel good. You're like, "Oh, I feel appreciated at work. They love me. They give me extra money." Most times when we get that extra money, what are we thinking about? So, told you, what are you thinking about when you get that extra money? What's your first thought when? I mean, it doesn't have to even be raise or bonus. Like when you get that extra money, what's that first thing you're thinking about?
I mean, I'm the wrong person to ask, because as soon as I get a little more money, I'm always thinking about inventory. NigerFoodDepot.com.
Okay, so you're
Yeah,
probably
so
the wrong person.
yeah, my lifestyle hasn't crept in a while.
So, well, for most people, when they think about when they have raises and bonuses, it's kind of like I want to go on this trip, but you should. I mean, there should be a balance in everything. Enjoy your life, oh, please, I beg. Enjoy your life. This life is there's only one life to live in this life.
Right, right.
Um, but it's like I want to go on this trip. I want to buy this. I want to buy that. Or now I can live in this really expensive neighborhood that I've been really wanting to live in. Um, but the thing is that if you were not money goals, it's important to set money goals. It's important to visualize the life that you want. And then you now have to like determine, how do I get to that life that I want comfortably? Not get into that life that I want where I'm still living paycheck to paycheck, but I'm getting to that life that I want comfortably. I think that's critical. So lifestyle crip is, you get a raise, and the first thing you think about is increasing your lifestyle to match exactly what your pay is. So now you went from paycheck to paycheck, you finally got that raise. You're not giving yourself a breather. You're now saying, "Oh, now I'm going to increase my lifestyle to go back to my paycheck to paycheck mode."
I mean,
Whereas
but how the haters gonna know that I got a raise? You know, I mean, I gotta let them see a little something.
that's the thing. You cannot live for the Joneses. You can't live for the Joneses. The Joneses ain't going to be there when things hit the roof.
Mm,
They will not be there. You will be
gotcha.
by
Okay.
yourself, by yourself, and by yourself.
Mm,
So I think it's important for us to be aware of that. So like the next time you get a raise and the bonus, think about, okay, especially your raises, when your salary increases, think about, I mean, yes, you should, if you want to increase your lifestyle, you could still increase your lifestyle, but it should be at some level of like, common sense, where you're kind of like, okay, I'm not going back. Now I'm making more. I'm not going to financially be where I am, where I'm still struggling to make ends meet. I am now going to find a way where I am still physically and emotionally comfortable, but I'm putting more away. I'm investing more. I've increased my 401k contribution, or now I can put more money in my brokerage. More now I can save more. Now I can start saving for my down payment or whatever it is you want to save towards. But now I can start saving away. So as we're thinking about buying that next brand new car when we get a raise, also think about your money goals for the future and how that raise can help you to start getting to your money goals.
gotcha. Gotcha. So it's another way to let your money work for you, basically. Like
Yeah,
with your increased spending power, increased buying power, it should translate to increased investing power, is what you're saying.
absolutely. It
I
shouldn't just be
mean,
increased
I mean,
spending power.
yeah. I mean, it
I like
doesn't
that
sound
summary you
fun.
just gave.
I mean, I listen. I listen. You know, yeah, I listen. It doesn't sound fun, but it makes a lot of sense.
It's
And
not
I know,
fun.
yeah, I mean, and I know one of your main principles that I've seen on your page constantly is how to give every dollar a job.
Hmm.
So instead of you doing all the work, like at some point your money should start working for you as well.
Yeah, and that's literally when life happens. Like, so right now, so you said it's not fun. Be willing to do the not so fun things right now, the hard things right now, just so a few years down the line, 10 years, 15 years from now, you are now, you've put your money to work, just so 10 years down the line, or 15 years down the line, or whatever amount of time, you've bought yourself freedom. So now the sacrifices you made now will now be paying you back in the future.
Okay, okay. And I just for anyone who's just joining us, like the way you broke it down, it leads back to the summary we had before for the portfolio for kids, where it was $200 a month at 7 to 10% annually over 40 years will get you to $1 million, and the amount you've put in is only 96,000.
Yeah.
That I I keep going back to that because it doesn't make sense, but the calculations add up. But just the like, okay, you put it's like you. It sounds like a get rich quick scheme. Obviously, it's not quick because it's
It's
40
40
years.
years.
It's
How's
40
it
years, but then it's like you're putting in $96,000 and
Yeah.
you're coming out with a million. And if it's in the right brokerage, right portfolio type, it,
Uh-huh.
it if some of them might be what tax free
Hmm.
on withdrawal or
Hmm.
something. It's like,
Yeah.
yeah, that sounds, it almost sounds too good to be true, but the math bears it out. So
Yeah.
it's like we've talked about like getting into the attitude of investing various platforms and avenues for for doing this investing. Some not so known, some pretty popular, like the 401k. And I wanted to go back to this because, again, I'm at this point, I'm just asking my own questions because it's like, I mean, why not?
You're getting free coaching session right now, I
I
told you.
mean, that hey, uh,
Illegal.
I'm like I'm saying, if it's available, why not? And and you asked your audience about like their 401k, and like I'm not sure if it was like specifics of it or if they're even like going into it. And the thing that stuck out to me, I'm like, no, this can't be right. It said 63% of your 401k is free money.
That's my own.
Yeah, yeah, well, for you. So it's like the
Yeah,
numbers
it's
might be
not
different,
everyone. For everyone.
slightly different,
Yeah.
but it's like a significant portion is just free money
Yeah.
when you break it down. And so like to give you the opportunity to like break down what you mean by like what percentage adds up to what percentage and how it, like, so if anyone else is doing the math, they can see what their percentages would be.
Absolutely. So I have two 401ks now because I've had two employers. But that one that I was alluding to was my first employer, which was a job I started in 2014. So from 2014 till, well, I left that employer in 2019. So I stopped contributing into that 401k in 2019. I only contributed from 2014 to 2019, which was 5 years.
Okay.
And within that 5 years, I had only put in. Let me pull up the percentages because you're like taking me back to all of these posts.
Hey,
I'm like,
I'm just saying, like,
so within that within that 5 years, I'd only put in, so like the percentages I broke down was based on last year.
okay,
And as of last year, if you look at the total money in that account,
okay.
I had only put in 37% of the total money in that account. But
Huh.
I had more than tripled my money. And the way I did it was my employer was giving me a match. So at the time, my employer was giving me 100% of 5% of my contribution. Every time I put at least 5% of my every time I put at least 5% of my pay, they would give me 100%. So that match over the 5 years period added up to 26% of what was in that amount last year. So it was 37% my money, 26% was my employer's money. And then the remaining 37% was over the from 2014 to 2020, the money had grown being
So
invested.
that's just your money, giving your money a job, and your
Uh-huh.
money working for you.
Yeah.
Whew.
So,
So
so I
so
only
it's like,
I only put in 37%, and the remaining 63% was free money, either from my
so
employer or the stock market.
huh. So yeah, the 63% was free money.
Uh-huh.
It comes out to that, like, and again, as someone who does not work a traditional job, who doesn't work in an office that offers that kind of thing, but to anyone who might be listening and your employer offers a 401k, the smart thing to do is to not only contribute but max it at least to the point that your employer matches.
Absolutely.
So
You should
max till they
definitely
match.
strive to at least match what your employer is going to match you. I know that was like a play on words, but
Yeah,
yeah,
it's
strive
yeah,
for that
it's
because that is free money that you are leaving on the table, and you don't want to leave that free money on the table. And there's always a clause associated with the free money though. You have to stay at the job for X amount of years. So my previous employer, I think it was like 3 years. My current employer, I think it's like 3 years. So like
mm,
3 or 2 years, I don't remember, but you have to stay there for at least that time period in order for that free money for it to be yours. If you leave before that time period, they can either take back all of their free money, or
ooh,
they can take back a percentage of that free money.
oh, okay.
That's not that many years though. I mean, stick it out.
I
And then you
mean,
can be like, goodbye,
there's
goodbye.
those. I mean, when you put it like that, I mean, again, it's free money.
Yeah.
So yeah, no, that I
Nothing is free though.
yo no, no, nothing is free.
Yeah.
I hear you 100%. But yeah, I know you have another engagement after this, so I don't want to keep you much longer. So for the people who have heard your some of the knowledge that you've dropped and they want to get some more, where can they find you?
So you can find me at Investing Paddy. So it's INVESTING, and then Paddy is PADI on Instagram. I am very active on Instagram. Send me a message, say hello. I don't bite. I actually love talking to people on there. So Invest in Paddy, and yeah, that's where you can find me on Instagram.
All right, and you
Oh,
offer
thanks.
like any services or because I know I've seen a bunch of your lives and I've seen like you had the Zoom session and it's
Did
like,
you
is there
join?
anything?
Did you join?
No, I was driving most of the day, and that's I'm trying to be a little responsible.
This
Not
is
I can't zoom and drive. That's
that's good. Yeah, yeah,
yeah
you're right. You're not
yeah,
supposed to.
but
You
I
shouldn't.
mean
You
I
shouldn't.
should exactly I shouldn't.
You should
That
not.
that is my official stance on this podcast. I do not zoom and drive. But yeah,
Amen.
so I'm just saying like in case people have heard like they've liked what they've heard or they want to hear some more or because I know you like the way you typically schedule your lives or the topics you discuss they vary, so it's like they might want like a specific topic or they might like one thing and want to hear more. So I'm just trying to make sure like the people who are listening can know where to find you, and also a way to say thank you for like offering your time and some of this experience to the podcast. And like we said, there are a whole bunch of things that we didn't get to cover, so if you have time for a part two, we'll definitely do this again.
Yeah, definitely reach out to me. We can make a part two happen if the people want it.
Yeah,
Um,
from the
yeah,
questions I've gotten, the people definitely want
what'd you say?
it. I said from the questions I've gotten, the people definitely want it. Yeah, yeah,
So yeah, I'm bummed that I can't see the questions.
yeah. It's so a lot of the comments are a lot of the comments are like they a lot of them are basically supporting my efforts in trying to get around the rules. So
Nice.
yeah, so it's like making an argument for counting
Uh,
off-campus housing as as as
as
educational. So for the
education.
529. So yeah, they're enabling
Oh,
me. We're all trying to find these loopholes. So yes, so um yeah, and I'm grateful for that because if some people are doing it, why can't we all?
it's honestly, information is powerful. So if they have the information, why not? Why
Right,
not?
right.
But like I said, you can find me on Investing Patty, and if you would like to, chat with me or get some assistance, I am also releasing a course by God's grace. It's going to come out at the beginning of February by God's grace. I say by God's grace because I got a lot of stuff.
Oh, and what kind of course is this?
It's going to be like, so it's titled manifesting your, like, bringing making your dreams come through investing.
Okay,
And most times we count ourselves out. We're kind of just like, I can't do it, or I can't reach that goal, or you know it's not possible for me, but it is possible. Like you've heard from just the numbers we broke down today. It is possible. It's just about being getting started, being consistent, being committed to the process, being patient, and just having that person to help you see the possibilities of what could be out there. So, in the course, we would talk about, money mindset. Like, we need to first start with the mindset. Like, we need to start shifting our view on things. Um, we're also going to talk about what your goals are. Like, what are your financial goals? What do you want to do? Where do you want to get to a few years from now? And then we will then work backwards to see, okay, how can we reach and achieve those goals? So it could be like further digging deep into, like, your 401ks, your HSAs, your regular brokerage account. What should you be invested in? Also for your kids, how do you start educational, like all these accounts that we talked about, how do you get started? Because yeah,
right.
I just spilled and give you guys a lot of good information,
That
but
you did.
it could be overwhelming. Getting started can be overwhelming, and I don't want us to feel overwhelmed. So that's pretty much what the course offers. An opportunity to jolt you to get started on this journey, because as we mentioned earlier, time is the your best friend when it comes to investing. Time
Gotcha.
is your best friend. So yeah, send me a
Uh-huh.
DM if you're
Yeah, so
interested.
I really appreciate you coming on to the podcast, and thank you to everyone who has listened. Remember, you can subscribe to the Well Actually podcast wherever you get podcasts, whether it's
Please
Apple
do.
Podcasts, Stitcher, Google Play. Well, I don't know if we're still on Google Play. I don't know. Or Spotify, Apple Podcasts, and of course here on YouTube for the videos. And I'm not going to make any promises, but we're going to try and do this again some maybe next week. I don't know.
We'll see.
If I can decide on what the topic should be, because there's a lot of weirdness going on in the world right now. So it's like trying to find something that isn't necessarily all just vaccine talk, and
Uh-huh.
I'm trying to stay away from that. I've done that too much. I'm like they everyone knows how I feel at this point, so I'm not
Yeah.
going.
And
I'm staying
there's
away
a
from
lot
that
of
topic.
regulation on that topic too. It's like
Yeah,
I
oh,
can't even say, like, you just post a picture that says the C word on Instagram.
yeah, and
Not
yeah,
even
and
typing
there's
it,
a
you
war.
just
Yeah,
posted a picture. It picks
yeah,
it up. It's
yeah.
crazy.
I
I'm like,
mean,
wow.
well, like I said, we're not going to get into that, but we really appreciate all the education and the information. Again, this is not investment advice. It's it's a roadmap to help you know where to look, know where to search.
Absolutely.
And thank you again on behalf of
Thank
the
you.
audience.
No,
All right,
thank you so
and thank you
much.
for listening to the Well Actually podcast.